Right, that's 11 o'clock and it's time to start the webinar. Thank you for joining us for our International Operations webinar today. Firstly, can I apologise for not running the webinar last week? It was originally scheduled for last Thursday. Unfortunately, events outside of our control prevented that from happening. Audio from the webinar is broadcast as part of the stream. If for some reason you're having difficulty with the audio, you can dial into the conference. You can see the dial-in number on the screen together with the conference code. There's a chat box that you can use for submitting questions. If you have any difficulties, please use the chat box and somebody here will try to assist. Please enter any questions that you have as we go along and we'll review the questions at the end. Okay, Online 50 software webinars, just a quick introduction if you've not been to one of these before. We're looking at operational requirements rather than software features. So starting from our topic, which of course today is international operations, we're going to look at what organisations need in terms of their operational requirements. And then we're going to consider how those needs are supported by software. Where possible, we're going to explore differences in different packages. Today we're going to be looking at Sage 50 Accounts and SAP Business One, both of which are available as part of the Online 50 service. And that allows users to make informed choices about the software that they need. So today we're looking at international operations. In these days of globalization and the web, even the smallest company can have an element of international operations, even if it's just buying something from an overseas website. Of course, the level of international operations will vary widely between different businesses, going from the smallest example of a business that only purchases goods and services from overseas, all the way up to an international business with operations in multiple jurisdictions that needs to trade internationally and produce consolidated financial statements. Today, the UK is a member of the EU. However, we have voted to leave the EU and it's unclear what that will mean in the future. It seems likely that this will require more businesses to think about the kind of topics we're discussing today. In today's webinar, we're going to consider currency, language, legislation, multiple VAT or tax registrations, and international consolidations. These are all aspects of international operations that can be assisted or in some cases hindered by software. We'll discuss the operational requirements and then look at what support for those requirements is available in software. Today we'll be considering the support in two software packages, as I mentioned. They're both part of the Online 50 service, so available for subscription from us. Sage 50 Accounts and SAP Business One. We are an OEM partner of SAP. That means the licenses that we issue are part for something called Ambition Enterprise, which includes SAP Business One software. So we're going to get started. We're going to look at currencies first. And of course, it's worth remembering that currency is simply a convenient medium of exchange for goods and services, without which it's virtually impossible to transact business. Although in theory, businesses can use any currency they choose, if you want to do business with someone, clearly you've got to use a currency that they're happy to use as well. So currencies typically are tied to governments controlled by a central bank. Bitcoins, of course, is an exception, and who knows what we might see in the future. As different national economies perform differently, the fact they're using different currencies provides some flexibility and also allows the central bank to exercise some useful controls over money supply, interest rates, and so on. International trade is normally carried out in a small number of currencies viewed as being international. So of course, as I said, you've got to use a currency that the other person also wants to use. So mainly that's US dollars these days. For example, Online 50, we do some business in Guatemala. We've never had to deal with Guatemalan quetzals. In fact, I didn't know what they were before I looked them up for the webinar. All of our dealings with Guatemala are in US dollars. Typically, Organisations only need to deal in a restricted number of currencies, and for the UK, what we'd be talking about is sterling, of course, US dollars and euros as the main currencies. Of course, some businesses may need to use a lot more currencies than that, especially if they're addressing specific markets. And of course, if you need to deal in more than one currency, then you have all of the requirements that go with that, even if you're only dealing two currencies. So today we're going to consider using currency in transactions, both the issuing and receiving of invoices in different currencies, as well as the exchange of payments. Holding currencies in different bank accounts. Recognising exposure to exchange rate fluctuations when there is value on the balance sheet tied to a different currency. And of course, we need to consider the impact of using different currencies in the preparation of appropriate management information. As a business is a legal entity, even if it is an individual trading as a sole proprietor, it has a legal home. We'll consider that in further detail when we discuss legislation, but for now we're going to stipulate that all businesses will want to prepare statutory information for the jurisdiction in which they are based in the currency in use in that jurisdiction. That means that every organisation will have a standard currency, sometimes also called a base currency, a local currency, default currency, which their accounts are based on. We're going to use the term local currency for this webinar, and when we use the term foreign currency, we mean any other currency. Okay, let's consider the implications of using currencies other than the base or local currency in transactions. I mentioned earlier the case of a business buying goods and services from abroad. In this scenario, probably the business will pay for these with a credit card, and the credit card company will convert the foreign currency to the credit card currency on the statement. This means that the transaction can be entered in the local currency equivalent, and the business could choose to ignore the currency of the transaction. It can be argued that if the purchase is for a material amount and the currency rate varies between the time of purchase and the settling of the credit card, then the business should recognise a foreign exchange gain or loss. However, most organisations, especially those that don't deal with currencies except in this limited way, are likely to be happy to take the exchange rate given by the credit card company at the time of the purchase. Moving on from this, businesses may be invoiced by suppliers in a foreign currency and then settle that debt at a later date. They may settle the debt using a credit card or by making a foreign currency transfer from their local currency bank account. In either case, as the transactions happen on two different dates, the exchange rate is likely to be different. And if it is different, then the amount in local currency will not be the same. This means that the local currency amounts of the original invoice and the payment of the invoice will not be the same. What does that mean in accounting terms? Well, let's do a worked example. Let's suppose we're operating a business in the UK, and so our local currency is sterling. We bought some goods from the USA on the 14th of June 2016, for which we pay $1,000. We're going to ignore any taxes incurred. We're only considering the currency effects right now. The currency rate at that time, I looked this up on xe.com, was 1.41101. So this represents a cost of £708.71. So we have a credit from the supplier, $1,000 for the goods provided, and a debit to our P&L of £708.81. Over the next few days, the rate gets better for us. This looks like happy days. We're going to end up with a bargain. But do you remember what happened a few days after that? We had the Brexit referendum, and there's a sharp fall in the exchange rate. So when we pay it on the 10th of July, the rate is 1.29381. Although I've managed to put the wrong rate on the slide. That represents a cost of £772.91. This gives us a difference of £64.20, which is an additional cost to the business, and this should be recorded as a foreign exchange loss. Of course, had we chosen other dates, then we may have ended up saving money, in which case we'd record a foreign exchange gain. You'll notice in my example that I've shown the payment leaving the bank in sterling. Of course, we may be paying from a US dollar bank account, but as our local currency, so remember that's the currency in which we prepare our accounts, is sterling, then I've shown the amount leaving the bank in sterling because our balance sheet is going to be presented in sterling. If we do have a US dollar bank account, then the value of the balance held in that account in US dollars will appear on our balance sheet in sterling because it's the local currency and because our balance sheet is always in one currency. Considering bank accounts brings us to how we need to work with currency assets and liabilities on the balance sheet. Our balance sheet, as we've said, is prepared in our local currency. We're going to think about using other currencies for the bank accounts and the balance sheet when we talk about international consolidations. This means if we've got assets or liabilities in a different currency, we need to show the revalued amount on the balance sheet to get an accurate balance sheet value. Now, of course, you may ignore that if the amounts you're holding are small, so any variations are not going to be material. We don't know that, so we need to be prepared to have that revaluation because we want accurate management information. So using the rates of the previous example, we had $1,000 in a bank account on the 14th of June. On that date, our balance sheet would show £708.71 as a current asset, cash in the bank. On the 10th of July, the slide still shows the wrong exchange rate. The cash in bank value, we've still got $1,000, but the value is now 772.91. No change in the contents of the US bank account. The revaluation, when we run that, will post a credit to the P&L account for the foreign exchange gain. When we're preparing a balance sheet, foreign currency assets and liabilities should be revalued to the balance sheet date. We should expect that if we have a foreign currency asset or liabilities, then each month, assuming we're preparing our management accounts monthly, the preparation of the balance sheet will create a foreign exchange gain or loss, reflecting the changes in the exchange rate. If we're talking about debts owed to us or by us, then the foreign exchange gain or loss is said to be expected. It's not realised until we actually settle the invoice. So let's take a moment to consider what support there is for handling currencies in both Sage 50 accounts and SAP Business One. Sage 50 accounts has some support for currencies if the foreign trader option is enabled. With this option turned on, you can select a customer or supplier account to be in a particular foreign currency. This will then mean that transactions posted against that account will be taken as being in that currency. Each time a transaction is entered, you'll be prompted for a rate to convert the currency to your local currency, and you can choose to have that rate saved. This is for convenience if you'll have a number of transactions needing the same rate. Sage 50 accounts only stores a single exchange rate for each currency and is not going to remember the rates on different dates. You can also specify a currency for a bank account, and the system will then treat all transactions using that account as being in the specified currency. At the time of setting up the system, it's possible to specify which currency is the local currency for the account, so you don't have to use it in sterling. You could set it to be euros or Danish kroner or US dollars. Everything else is going to work exactly the same way as it would in a UK company, but you can say our local currency is, as I said, euros, US dollars. Normally, of course, it's pound sterling. And then when you specify the exchange rates, you're looking at conversions from the local currency. The system allows you to revalue any foreign currency bank accounts, but it does not allow you to revalue debtors and creditors. So Sage 50 accounts has got basic support for operating in different currencies. For lots of organisations, this is going to be enough. But for a business that's got a significant volume of foreign currency transactions and whose foreign currency debtors and or creditors represent a material consideration, then really they probably need more support. They need to be revaluing debtors and creditors, and they can't do that easily in Sage, so that would mean manual journal adjustments, and obviously that's going to become cumbersome. Before we look at the support available in SAP Business One, we're going to look at a couple of Sage 50 videos. Our Got a Minute videos are designed to answer a single question in 60 seconds. You can find them in the Online 50 YouTube channel. Our first video shows how to enable foreign trader in Sage 50 accounts and set up a foreign currency supplier and bank account. Okay, I managed to get all of this to work before, so let's hope it all goes smoothly.
In order to use multi-currency in Sage, the foreign trader needs to be enabled. This will then allow you to be able to choose different currencies for your customers and suppliers. Now let's set up a dollar bank account. You will see that in my next video, I will use this account as a dummy bank account in order to pay an invoice which is in dollars. Now that the foreign trader is enabled, I can go onto my supplier tech guides and change the currency from sterling to dollars. As the exchange rate changes all of the time, there is the option to do a foreign bank revaluation to ensure that the correct exchange rate is being used.
Okay, so in that video, Tiffany mentioned that she should be using the dollar bank account in the next video. It's very common that companies with a low level of foreign currency transactions, for which Sage 50 accounts may well be a good fit, do not have any foreign currency bank accounts. If you don't have a foreign currency bank account, then paying a foreign currency the way Sage Tech Support advise you to is a painful process. It's much simpler to use a dummy bank account. What you do is record the currency transfer going from the local currency account to the foreign currency account at the correct rate. This then gives you the amount to pay your supplier in your foreign currency account. You can record the payment to them in that currency, which nets off the foreign currency account to zero, leaving you with no foreign currency assets to revalue. So here's Tiffany again in the next Got a Minute video, just showing us that process.
I have a supplier invoice to pay which is for $1,000. However, in Sage I face an issue where the currency on the invoice has to match the bank account from where the payment is coming from. I do not have a dollar bank account, so what I've done is created a dummy dollar bank account. I now need to transfer the equivalent of $1,000 from my UK bank account into the dollar bank account. The conversion has already been calculated with the exchange rate of 1.3. The bank transfer has been made and the currencies now match, so I can now pay the tech guy's supplier invoice for $1,000 from the dollar bank account. Using a dummy dollar bank account makes it clearer to see that the payment of the invoice has been made for audit trail purposes.
Okay, so in summary, Sage 50 has basic support for companies that need to process foreign currency transactions. It's straightforward to use the features provided. However, the limitations of the system mean that companies that have a higher volume of transactions and carry foreign currency assets or liabilities on the balance sheet may need something with enhanced support. So what about SAP Business One? Well, SAP Business One is intended to be an international product. As such, operating in different currencies is part of the design of the product. It's not something that's been considered as an extension to the product. SAP Business One is fully multi-currency throughout the system. What do we mean by that? Well, it allows any account in the system, so that's nominal ledger accounts, customers, suppliers, bank accounts, to be set up to use any specific currency or all currencies. Why might we want a single account to operate in multiple currencies? Well, if you have a customer that you will invoice sometimes in sterling and sometimes in euros, then you don't need to set them up as two customer accounts. Of course, you could set them up as two customer accounts if you wish, but you don't have to. Each invoice or order is going to be in just one particular currency. So you can't mix currencies on an invoice, but you can have different invoices in different currencies being posted to the same account. You don't have to restrict that. And of course, bank accounts, if you're going to send foreign payments from your UK bank account, which is quite common, then you may want to record that actually it's $1,000 that's left the account and record the exchange rate on that transfer. And as you can have any account set to be any currency or all currencies, you can also revalue any account, which of course allows you to revalue your debtors and creditors. Also, in SAP Business One, exchange rates are stored by date, and you can enter unique or spot rates for each transaction if necessary. Also built into SAP Business One is a dual currency nominal ledger. When we consider international consolidations, we're going to think about that in more detail. Before we look at how this works, we're going to look at another Got a Minute video. This time we're going to look at the same process we saw in Sage 50 accounts, paying a foreign currency invoice when we don't have a foreign currency bank account. In this video, we've made a payment at the time of order, and so we'll be entering the invoice and the payment together. Okay, here's the video.
It's got a minute video in posting foreign currency transactions in SAP. In this example, we're going to pay an AP invoice, so I go to Purchasing, AP Invoice. I'm going to select a US dollar supplier. And here we can see the rate of $1.1 to the pound. I'm going to select my item and put in the posting date, and as you can see, the invoice is for dollars. I'm going to make my payment through the payment means. I'm going to pay with GBP, select my bank account, and as you can see at the bottom, the US dollar amount's converted into the GBP amount. I'm going to select the total amount, select OK, and then I'm going to add the AP invoice and the payment.
Okay, we're now going to look at how SAP Business One handles the posting of multiple currencies. As I previously said, any account can be set to handle any currency or all currencies. So how does this affect posting transactions? The two currencies that can be set on the nominal ledger are referred to as the local currency and the system currency. If an account has been set to the local currency, then postings to that account can be made in the local currency only. The account balance is maintained at all times in both the local currency and the system currency. If the account has been set for a specific foreign currency, then postings to that account can be made in either the local currency or in the specific foreign currency. The account balance is always maintained in the local currency, the system currency, and the specific currency that you've chosen. If the account has been set for all currencies, then postings to the account can be made in any currency you like, which of course includes your local currency. The account balance is maintained in the local currency and the system currency. So we can see from the chart we can always post in the local currency, and that the account balance is always available in both the local currency and the system currency. If a specific currency is set, then the account balance is also available in that currency. We're going to take a few moments now to consider how the systems handle price lists. Both Sage 50 and SAP Business One allow users to set up price lists. This allows you to give specific pricing to a customer. Going into different pricing options available is beyond the scope of what we're going to look at today, but we are going to look at how currency is handled in price lists. In Sage 50, each price list is going to be for a single currency. You can assign the price list to a customer, provided you set the customer to use the same currency as the price list. In SAP Business One, each price list can be for 3 different currencies. So for example, you may have a price list that specifies prices in sterling, US dollars and in euros, one price list. When the price list is used in an invoice or a sales order, which selects the customer's pricing by default, so the price list is attached to the customer and the invoice is raised on the customer, so it's going to use the customer's pricing, then it's going to attempt to use the pricing that matches the currency of the invoice. So remember we said your sales orders and invoices can only be in one currency. Pricing on that is going to try and match from the customer's price list the pricing that you've set for the document. So for example, if you use this price list for a sales order in US dollars, the system will automatically select US dollar pricing. For a euro sales order, the system automatically selects the euro pricing. Now, should you wish to, this allows you to reduce the number of price lists that you need to maintain, because you can offer comparable volume or preferred pricing to customers that trade in different currencies. So you don't have to have a euros distributor price list and a sterling distributor price list and a US dollar distributor price list. You can have one distributor price list, and it doesn't matter which of those 3 currencies people are using. Many businesses have specific requirements for pricing, which can make pricing a very complex area, and it's beyond the scope of what we're going to look at today. So in summary, price list Sage 50 single currency must be the same as the customer. SAP Business 1, 3 currencies. It matches the currency on the document, they call it in Business 1, so the sales order or the invoice, that will choose the matching currency, and that allows you to simplify a number of price lists. If there isn't a matching currency in the price list, then it works out a conversion rate from the local currency. Everything defaults back to the local currency. It doesn't raise it in local currency, it will convert it. Okay, we're moving on to our next consideration, language. When we're dealing with language, we need to recognise that there's lots of different considerations. So what do we need? So we're talking about language internally, so within the company, as well as externally, so language that you can present to your customers, for example. It's not uncommon these days for people to be employing people whose first language isn't English. They may not be living in the UK. English may not be the second, third or even fourth language. And for them, a product which is presented to them in English could lead to some misunderstandings. We're going to talk about printed documents. When we say printed, of course, that means the documents you're exchanging with your customers. These days, of course, a lot of them aren't printed. They're PDF'd or exchanged in some other way. So let's deal with Sage 50 first. That's unfortunately quite straightforward. It's English only. So the user interface for the product is always in English. Product help and support is always in English, and there are no facilities included for putting foreign language into printed documents. So the only way you could do that is, let's say for example you were doing business in France and your customers wanted your invoices to have French descriptions of the products on. You'd have to set up different product codes and type in the French descriptions for those, so you'd effectively be selling them the French description of the product rather than the real product. Difficult to do in volume, difficult to do if you're actually trying to maintain stock levels and so on, but that would be your only option. In SAP Business 1, it is possible to change the user interface of the program for specific users. So a specific user can say, I would rather see my interface in Spanish because they're based in South America, possibly Guatemala. We spoke about that earlier. And they would then be able to get help in Spanish, and the user interface can be presented to them in Spanish. There are 27, I think, different languages available. It's designed as an international product. It's worth, of course, saying at this point that if you do phone Online 50 for support, we only give support in English. The alternative to that would be to use a translation agency, which obviously is fairly simple to arrange, but sometimes things get lost in translation. There's also limited support for changing the language in transactional documents, so the printed documents we were talking about earlier. So when you're assigning product codes to an invoice, each product code has two description fields. One is the description and one is the foreign language description. Now, of course, there are only two, but in the scenario we mentioned earlier, a French company wants a description in French. You can set them to use an invoice layout that presents not the English description but the French description for the product, and then that will appear on all of their invoices. That's got a benefit that you can keep a single stock code. You're not trying to remember which stock codes go to which customers, but there are only two languages available. It's a description and an alternate description, so there's only two. We're now going to look at another one of our Got a Minute videos. This time it's going to look at how to change the help language in SAP Business One.
This is a quick demonstration on how to change the default help language in SAP Business One. First, log into SAP Business One, then open up any menu item. If you press F1 for the help screen, you may find that the language displayed is not what you require. To change, simply click Help, Documentation and Help Settings. From the language drop-down box, choose your preferred language, then click OK. If you try F1 again, you may find that your settings have not yet been applied. To resolve, simply log off and back on again, and you will now be able to see your chosen language. You can also get specific help on a field by simply pressing Shift F1. And that is how you change the default help language in SAP Business One in 60 seconds.
Right, okay, let's move on. The next topic to consider is legislation. For an organisation with international operations, it may well be that it has different legal entities incorporated in different jurisdictions. Each of those legal entities must comply with the legislative requirements of the jurisdiction that it operates in. And this is an area where there is significant divergence in the two products. SAP Business One was designed to be an international product and to support operating in different jurisdictions. Sage 50 accounts has been developed for the UK market and adapted for the Irish market by minor tweaks to the VAT rates and presentation of VAT areas. The Sage Group, as a global company, has other products in different regions. Typically, these are from companies that have been acquired by Sage. Those products have been developed completely independently, but they've now been renamed to identify which market segments they're addressing. So we've ended up with a situation where the Sage Group has lots of different products, all called Sage 50. So the intention is you can understand which market segment the product is for, and therefore you would know if you've got a subsidiary in France and a subsidiary in the US, and they are the right kind of size companies to be running Sage 50, then the Sage 50 product in those jurisdictions is likely to be a suitable product. But it isn't the same product. The North American product called Sage 50, the UK product called Sage 50 are completely different. What we've found, we obviously have users all over the world, is this causes lots of confusion because users often think if a product is from what they believe to be the same supplier and is called the same thing, that it actually is the same thing. And that, on the face of it, doesn't seem that unreasonable. In contrast to Sage 50 accounts, SAP Business One is sold in over 150 countries. It's one product supporting different legislative rules, they call them localizations, to be used in different jurisdictions. So although the product is sold in over 150 countries, there aren't 150 different localizations, as many jurisdictions have common operating rules. Where legislative rules are compatible and only tax rates need to vary, for example, then it can be easily configured within the product. So it's not unreasonable. We spoke Sage 50 is sold in Ireland, and if you buy the Irish version, it defaults on setup. It has the Irish VAT rates, and the submission is designed for Ireland. So it's not unreasonable that you can take a product and re-enter the tax rates to the appropriate rates if there are, and any other minor parameters that need to be tweaked. Okay, so that's legislation. We're going to move on. Related to legislation, we're going to think about multiple VAT registrations. So, the UK is still part of the EU. We have voted to leave. We don't know what that's going to mean. Current EU legislation stipulates that if a business is selling to consumers in a different territory within the EU and passes the threshold to be registered for VAT in that territory, then that means they need to submit a VAT return to that territory as well as to the territory in which they're based. So that means a single legal entity being registered for VAT in multiple EU countries. Now, of course, the VAT is a complex area. There are some exceptions to that. So, electronically delivered downloads, for example, there's a slightly different regime. There's systems set up to be concerned about different types of fraud in different markets. So VAT is a complex area, and we are, of course, simplifying it in what we've said there. So the UK's future relationship with the EU is uncertain at this point. However, it does seem very likely that companies in the UK will be continuing to trade with the EU. We certainly have seen overtures from the Irish government about setting up an Irish subsidiary in advance of any negotiations, which would mean we could trade with the EU through the Irish subsidiary, for example. And the Irish subsidiary, assuming Ireland remains part of the EU, would be subject to the same regulations we're talking about today. So we're talking about a consideration for a single legal entity reporting VAT to different authorities according to where their customers are. How can we handle that in software? We actually got asked this recently on the help desk. Here we go. Software, of course, tracks VAT by assigning appropriate tax codes to sales and purchases. Normally, it's on a line-by-line basis, so different items on the invoice can be subject to different VAT rates. For example, in Sage 50 accounts, the standard rate of VAT is applied by setting tax code T1. Both Sage 50 accounts and SAP Business One support defining multiple tax codes and setting the rates for those codes separately. In Sage 50 accounts, there are limited options that can be set with each tax code. A tax code can hold a single rate. It can be marked as being part of the VAT return. It can be flagged as an EU transaction for sales or purchases and for goods or services. In other words, it's possible to define everything for the system to know how to include the item on your UK tax return. By using codes and setting them as not being part of the return, it would be possible to compile transaction lists and summaries for transactions on those codes, and from those lists and summaries to prepare a VAT return for submission under a different jurisdiction. However, this would be a manual process, and the system won't separate the VAT liability for different jurisdictions. So in other words, on the balance sheet, you won't have a different balance sheet position for the VAT that you owe in different jurisdictions. With SAP Business One, it's possible to set up multiple tax returns. Which codes are part of those returns, and for different codes to specify different balance sheet accounts to track the liabilities. It's also possible to hold different rates for different dates, which means that if any of the jurisdictions you're in change the VAT rates, all of that can be set up in advance. You don't have the mad scramble to adjust VAT rates on documents should something change in the future. So by using tax codes, we can record sales to be returned in different jurisdictions. Although the principle is the same for both packages, there's much better support for this in SAP Business One in Sage 50, where the reporting overhead will be much higher. And one of the reasons for that, of course, is SAP Business One, because it's been designed to be sold internationally, has to be able to cope with the way tax regimes work in different parts of the world. So in the EU, VAT is very similar in different countries. Obviously, EU mandates VAT legislation, but the way state and federal sales tax works in the US, for example, is quite different. So because Business One needs to be able to handle that, you can define how the tax codes get set up, and once you've defined that, then it's obviously possible to collate the tax code the amounts charged on the different tax codes separately into separate reports, and each tax code can specify different accounts on the balance sheet in which to hold those liabilities. Okay, the last area we're going to be looking at today is international consolidations. This is where we need to collate accounts from different companies operating in different countries into a single set of group accounts. So at its simplest level, preparing consolidated accounts is aggregating the different trial balances. Things can become more complicated than this, as we'll see in a moment, but in the simplest case, we prepare a trial balance for each of the subsidiaries, revalue the trial balance to a common currency, normally the currency in which the holding or group company is reporting. Of course, when you do that, make sure, because you'll have rounding differences, that the trial balance still balances, because you shouldn't clearly have a trial balance that doesn't balance. And once that's information, we've got to once that information is prepared, we may need to remap some of the nominal codes from subsidiaries. So we've got things mapped consistently. We've then got TBs that can be available both for comparison and for aggregation into a whole. Now, different businesses will have different requirements for information from the consolidated accounts, and this is where things can become more complex. It's the information requirements for consolidated accounts which will determine how they need to be prepared. For example, if there's a requirement to compare performance in different periods, there must be figures prepared on the same basis. So you've got to have figures for each period. To understand sales by product categories, then there must be figures for sales by product categories. Now that could come from nominal codes, so it may still be possible to do that on the TB. You may want that by customer groups. Again, could you do that on the nominal ledger? You may be able to, you may not. It depends what you need. So you need to understand what information is going to come out in order to prepare the information properly so that you can get that information out. In the simplest case, we might get away with the importing of individual TBs into Excel and using a pivot table or something like that to aggregate and summarize the information. As our information needs increase, then we need to consider how we'll be able to meet those needs and support possible changing needs in the future. If we want to use more advanced reporting tools, then we'll probably need to put the data into a suitable database structured in the correct way. Sage 50 Accounts has a range of standard reports but does not provide more in-depth information tools, sometimes called business intelligence tools. The slide there I can see says Sage 50 Accounts has dimensions. I think that should say Sage 50 Accounts has departments. So in Sage 50 Accounts you can set up departments, and you could in your consolidated accounts have each subsidiary going into a different department, and then you can do comparisons against department, for example. So if Sage 50 Accounts does have everything you need, then you could set up a Sage 50 a company using the appropriate currency for your group reporting, import each of the TBs for the subsidiaries period by period if you need to, with different departments if you need to, assigning the departments based on the subsidiary, and you can then produce reports from that information and use the departmental reports to report on the individual subsidiaries. Now, departmental reports have a reputation for being slow in Sage 50. We run SAP Business One on SAP HANA, which is an advanced in-memory database that's used for demanding information requirements where access to real-time information is essential. So when real-time, we mean we want answers in seconds, not minutes or hours. So it's used in things like Formula One, predicting what's happening on the track, that stuff where split-second timing is essential. This means that it's possible to build a wealth of business intelligence reports from the data if it's consolidated into SAP Business One. That could include dashboard widgets, predictive analytics, and all that kind of good stuff. SAP Business One also gives a range of dimensions that could be used for different companies, both using nominal ledger dimensions. There's up to 5 of those. Segmenting the nominal ledger codes, you can have up to 10 segments. Each segment obviously can hold multiple values. As the SAP HANA database can deal with very high volumes of data, it's viable to consider consolidation based not just on the account balances, but also transactions, which then allows the broadest possible range of options. So that touches on something we'll be exploring in more detail in our next webinar. I'll just mention that briefly. Profit Centre Accounting, we're going to be running that on the 29th of June, last Thursday of June. We'll be looking at how to look at profitability in different ways by departments, projects, stock items, and so on. In terms of international consolidations, if we have consolidated our international subsidiaries into a single data set, then we can use the same tools and techniques to analyse performance by the different subsidiaries. So, coming back to today's seminar, just before we look at questions, we're going to have a quick summary. There's been a lot of ground covered today as we've explored our key areas for consideration. So in summary, Sage 50 Accounts is a great general purpose small business accounting system. It's got basic support for using different currencies. It's English language only, and although it's possible to tweak parts of the configuration like tax rates, it's designed for use in the UK only. In theory, different tax returns, VAT returns, could be handled by configuring tax codes, but you can't separate any liabilities on the balance sheet. As I say, in theory, but that's going to be a manual process. SAP Business One can offer support for companies that have international operations. Its currency handling is much more sophisticated. We call it fully multi-currency, and we've looked at the difference there. It allows you to revalue debtors and creditors, as well as ensuring that your nominal ledger is always balanced in 2 currencies so that consistent reporting is made easy. You can have multiple languages in the program, including having different users in the same company seeing the program in different languages, and it's been designed to work with different legislative rules. It supports the creation of additional tax schemes and can separate liabilities on the balance sheet. So Sage 50 Accounts could be a good fit for a company with basic needs, company that needs something with a bit more sophistication, or who are have more exposure internationally, higher volume of transactions, carrying foreign currency assets and liabilities. They're going to need something more sophisticated and almost certainly should be considering the options in SAP Business One. Okay, so I've been talking for quite a long time. Thank you for your patience. I can see we have got a few questions in. There's still time to type in more, so keep them coming. And we're going to have a look and see what questions we have now. Okay, I'm going to run through the questions we've got here in order. First question, how much is the foreign trader license for Sage 50 accounts. Okay, so the question is foreign trader. We mentioned that if you have that enabled in Sage 50, that is enabled with Sage 50 accounts professional, which is the highest license level. With Online 50, if you have that as part of your service accounts professional, is £58.49. I think the current price from Sage is £125, so that's both per month. Obviously prices can change. Sage set the price of these products. If you don't have accounts professional, say you have accounts or accounts plus, then you can license foreign trader. I'm not sure off the top of my head what the price for that is. We will look into the prices. We'll post that on the slide before we post the video, so we'll get that information for you. Thanks for that. Keep any questions coming that you've got there. Next question I can see: why would you invoice the same customer in different currencies? So I mentioned that in the talk. I appreciate you may not have come across this before. I have come across it a couple of times. Normally it's to do with getting rid of currency risk. If the supplier and the customer both agree that they can be invoiced in different currencies, then that may well happen. An example to illustrate that: if you have a company, one I can think of, they facilitate events in different locations. If they're facilitating an event in Spain, most of the costs associated with that event are going to be in euros. So if they're charging the customer for that event in euros, then they mitigate the currency risk. They may have a customer who's asking to organise events in different territories, so they may do some events in the UK, let's say Bristol and Barcelona and Nantes in France, and according to where it is called, depends what the costs for that event that they've incurred. They can bill the customer in those in that currency. Another example I can think of, very similar, somebody providing a service, but it's a service that they deliver in different territories. So the example I'm thinking of, they're running some training sessions. Copenhagen, obviously that's in Denmark, Danish kroner. Dublin in Ireland, euros, and New York, which is US dollars. So depending on the territory, they charge for the course that people are going on, the training sessions, in that currency. So again, if a customer is sending people to those different locations, they may well be billed in different currencies. So it's all to do with currency risk. Of course, you don't have to bill the same customer. You could choose to set up a customer account and only bill that customer in one currency. And if the same customer wants to be billed in different currencies, you could set up a second account. The issue is that you can choose to do that if you want, but you don't have to choose that if you're using Business One. Okay, moving on. Another question. If you set up multiple VAT returns, what happens with the EC sales list? Excellent question. Chris, do you want to handle that one?
Hello. The EC sales list is built based on the tax codes that are recorded. Only transactions with the appropriate codes are included on the list. If you use different codes, then those transactions will not be on the EC sales list. You should only report items on the EC sales list to HMRC that are part of the UK VAT. If you are not reporting the sales in the UK, then it shouldn't be on the UK EC sales list.
Okay, thanks, Chris. So clearly the HMRC is responsible for UK VAT, and so the EC sales list that you send to HMRC is for sales that are subject to UK VAT. If they're being reported in another region, they're not subject to UK VAT, so they're not on the EC sales list. Thanks for that. We're going to carry on. Keep any questions coming that you've got for as long as we can. We'll press on with those. Right, another question here. Right, SAP HANA. You said SAP HANA is fast enough to consider consolidating to transaction levels. How fast is HANA? Excellent question. It is fast. It's really fast. So if you build a information system on top of HANA, there's three main factors that are going to improve the speed. The first is that it's an in-memory database. So that means all of the data is in memory all of the time, not just the indexes, which is what you can get in some other memory caching databases. They put the indexes in memory for speed. In HANA, all of the data is in speed, so you don't have to fetch data from the disk. Now, you can have fast disks, of course, but you've got to seek to the right place, and clearly fetching from memory is very, very much faster than fetching from disk. So that's the first thing. Second thing is HANA supports something called column stores. So most relational databases, which is what a business information system is going to be built on, most relational databases receive records transaction by transaction, so one record at a time, as does HANA, of course. And because they receive one record at a time, they organise the data in records. So internally, the structure is based around the record. Now with HANA, it turns it sideways. So it still receives it one record at a time, but internally it organises it, instead of by records, by columns, which optimizes it for retrieval. So one of the effects of this is you have effectively indexed every column in the database. Some fields in a traditional relational database, if you search by a field that isn't indexed, it can be quite slow. Well, in HANA, effectively every field is indexed, so you don't get that performance hit however you choose to analyse the data. It does mean that compared to reading, writing is comparatively slow because it's got to reorganise the column store, but don't forget it's all in memory, so it's quick. That's probably fine for most people. If you consider in your business system, you are probably writing the transaction only once. Can't imagine why you'd be writing it more than once, but you're going to read it many times. So every time you look at the account balance, every time you produce any reports, every time you try and process anything to do with that transaction, it's getting read. It's going to be read very many more times than it's written. So a system that is optimized for reading over writing sounds like a pretty good idea. There's something we quote by a database consultant who did a comparison with Oracle. Oracle, a well-respected enterprise-level database, versus SAP HANA. We'll put the quote up on the slide when we post the video. And they said that the report they were running, in a conventional Oracle system, to get the information out took several hours. But in HANA it was seconds to come out. So that's compared with Oracle, which is of course a big enterprise system. If you compare the speed of HANA to something like Sage 50, which isn't using, it's still a relational database, but it isn't using a database server technology on the back end, I don't think there'd be any comparison in terms of speed. In fact, that sounds to me like a great idea for us to explore. If we take a system and say 100,000 transactions, then we can see how fast HANA is with 100,000 transactions, how fast Sage is, maybe look at some other systems as well, just to give people a feel for performance. I quite like that. I think we'll look into it.
There's also a third factor.
Sorry? Yes, okay, yes, three. I said three. Thank you for reminding me. So in-memory column stores. And the third one is the HANA service layer. So what does the service layer do? Well, it allows us to code a solution so that any processing that needs to be done of the data can be done where the data is. So it's not uncommon that when you're trying to process information, you might need to fetch some information, process an intermediate set of results, use that result set against some more information that you get, and process the results again. So if you can put the processing where the data is, you're avoiding that transfer of the information over to the client machine that's requesting it for processing and back again to get the next set of queries. So you're avoiding network delays. So obviously at Online 50 we've got very fast networking infrastructure, but still there's going to be a delay. If we think about how that works, I spoke earlier, didn't I, about 100,000 transactions. Let's use that as a figure. We've got 100,000 transactions being processed. If we've got to read all of those across the network, process them, send them back, read the next lot, send that back, that's 4 network round trips. If the network delay is only 1 millisecond, we've got 4 trips for 100,000 transactions, 400,000 milliseconds, 400 seconds, which is 6 minutes 40 seconds, and that's just dead time. Now, of course, there's different ways you can optimize your processing, but being able to use the HANA service layer means you can run the code where the database is, and of course the database has all of the data in memory all of the time. You can get some really quite phenomenal results. Clearly, using that service layer is something that needs to be designed in when the application's being built. So it's not necessarily something that a user can tweak unless they've got those skills. But of course, we're talking about use of Business One, an application that has been built and designed by SAP, who have also built and designed the HANA database that it runs on. So that was a great question. Thank you for that. Sorry, I may have got a bit carried away there. Another question in here. How much is SAP Business One? Excellent, a direct question. We're comparing SAP Business One and Sage 50 today, so it makes sense to think about the price in terms of comparing those two, I guess. We've already said that Sage 50 Accounts Professional is $58.49, with Online 50 $125 from Sage currently. If we compare that to the closest equivalent license with SAP, we have the Ambition Accelerator license based on SAP Starter Pack. That's for up to 5 named users. Has all of the features that you get in Accounts Professional, but there are some features of SAP that it doesn't have. So, for example, service contracts would be one of those. That license, sorry, there's been a bit of preamble. It was a direct question. This is the direct answer. That license is £26 per named user per month. Now, it is per named user. Sage is licensed by simultaneous users, concurrent users, so the way it's licensed is slightly different. If you need more than 5 named users, or you need some of the features that aren't in the starter pack, then you either have a full license. Ambition Advantage is how we license it. That is £62 per month. Or a limited license, which doesn't give you all of the features but gives you their overlapping subsets of features according to what that role would be. Those are £31 per month. So you have a mix and match of full licenses and the limited licenses according to what you need. Details of the commercial proposition and the pricing are on the Online 50 website. If you go to www.online50.net, look at Online SAP, and then under there's an option, I think it is, again, we'll put this on the slide when we post the video. I think this is SAP Business One from Online 50, I think is what it's called. So we'll put a link on the slide when we post the video. Okay, there aren't any more questions in there. There is still time. We have run a bit over time, but we're still here. If anybody has a question, put that in. It'd be great to see you, or have you attend at least for our next webinar scheduled for 29th of June. Now, we mentioned this earlier. We're going to be looking at profit center accounting is what we've called it. It's looking at how people determine profitability by different aspects of the business. So depending on what the business is will depend on what their needs are, how they're going to analyse that. So that might be by department, by product group, customer group. The considerations today, obviously with international operations, you might be looking at that by territory. So it's an opportunity to think about, once we've captured that information, how do we turn that data into useful business information? So that's going to be 29th of June. Obviously there'll be emails going out to invite you to come to that. So thank you all very much for attending today. We have gone on a little bit longer than we had expected, but that's fine. It's great to have questions to answer. If you have any more questions for us, then obviously you can contact us. Our main website is www.online50.net. The telephone number here in the UK is 44 is the UK country code, 207 537 0101 is the main switchboard. If you have any questions, obviously do come back to us, and we'll send out the email with the link to the video once it's posted, and in due course obviously we'll send out invites for the next webinar. In the meantime, it's been my pleasure. Thank you very much, and goodbye.